A major rethinking of sovereign reserve policy is underway, and Germany helped spark it. Now, for decades, most central banks stored their gold abroad, with the U.S. Federal Reserve Bank of New York acting as the de facto global vault. Gold, a non-political zero counterparty reserve asset, is emerging as the big winner in a world fractured by tariffs, geopolitical risk, and fading trust.
Germany and Italy are pulling $245 billion in gold out of the U.S., not through wires, but on military cargo planes. Why? Because they no longer trust America's vaults or Trump's tariffs. If this gold exits, it could spike your mortgage, sink the dollar, and set off a global financial storm. This isn't just a currency crisis, it's a confidence collapse. What happens when allies stop believing in the dollar? Watch closely. This is only the beginning. Germany and Italy just sent shockwaves through global finance. Between June 23rd and 27th, 2025, both countries officially demanded the return of their gold reserves from the New York Federal Reserve, about 3,800 tons combined, worth nearly $245 billion. This isn't a wire transfer, it's physical bullion being flown home on military cargo planes. Roughly one-third of Germany's total 3,352 tons and 43% of Italy's 2,452 tons are stored in Manhattan. It's not just gold, it's a message. Trust in U.S. vaults. And its leadership is eroding fast under Trump's tariff pressure. This marks the largest repatriation demand in decades, signaling a historic shift in global financial confidence. Between April and June 2025, President Trump unleashed sweeping tariffs, 25% on steel and aluminum, labeling them national security measures. These sudden spikes sent European markets reeling. German steelmaker Salzgitter warned it was hit hard, while EU stocks dropped nearly 1% by early July. Germany's CDU MEP Markus Ferber warned, "Trump is erratic and one cannot rule out." Creative ideas how to treat foreign gold reserves. Meanwhile, Italy's Prime Minister Giorgia Meloni, who once pledged to bring gold home, is publicly silent as her export-led economy braces under U.S. pressure. These tariff shocks shattered long-standing trade trust and catalyzed fears that America could weaponize not just commerce, but central bank assets. Germany and Italy responded not with another round of talks, but with urgent orders to reclaim tangible assets. And that's why they're acting now, because tariffs aren't just draining wallets. They're draining confidence. This isn't the first time U.S. allies have pulled their gold out of American vaults. In November 2014, the Netherlands secretly repatriated 122.5 tons of gold from the New York Fed, reducing their U.S. holdings from 51% to 31%. The move was intended to rebalance risk and restore public confidence. A year later, in 2015, Austria repatriated a significant portion of its 280 tons of gold, moving 15 tons from London and planning a two-step relocation that would eventually bring half its reserves back home. These discrete operations, executed with specialized logistics and tight security, show that central banks can and will physically move bullion when trust is at stake. Fast forward to today, Germany and Italy are taking that playbook and dropping a spotlight on it, demanding a multi-billion-dollar haul in public. Belgium and Switzerland have already pointed to these past moves as proof that large-scale gold repatriation is doable, and now Germany and Italy are making it seismic. The script is familiar, but the scale and transparency are unprecedented, and the markets are watching. As news of the gold pullout spread, global markets rattled. Foreign central banks cut New York Fed holdings by about $90 billion since March, the lowest level since 2017, signaling a clear shift away from U.S. assets. This drop included a sharp $17.1 billion sell-off in a single week. Faces at the Fed took notice. Dallas Fed's Lori Logan warned that tariffs could disrupt inflation and market stability. The reduction in Treasury collateral sparked intraday volatility in repo rates, a key measure for short-term funding. Higher repo rates mean banks and funds pay more to borrow overnight. That raises borrowing costs for households and businesses. It also limits the Fed's breathing room to manage interest rates. In short, gold going home isn't just symbolic, it's destabilizing the plumbing of global finance. As gold exits, bond markets feel the tremors. In early June, Germany and Italy quietly sold $4 billion in long-term U.S. treasuries, triggering wider bid-ask spreads and market jitters. Analysts warned that a coordinated sale of $18 billion could raise the 10-year yield by 5 to 6 basis points, enough to send the average 30-year mortgage over 6.9%. That means monthly payments could jump by hundreds of dollars for new homebuyers. Higher yields also increased rates on car loans and state infrastructure bonds. In fact, home builder sentiment dropped to a 2.5-year low, with 37% of builders cutting prices amid rising borrowing costs. With Treasury yields climbing, mortgage rates follow suit. They're up from around 6.7% in early June to around 6.77% now. Ultimately, this isn't just on Wall Street, it's hitting Main Street, and it's likely to stay elevated through 2025. This gold repatriation is not limited to Germany and Italy. China's central bank has increased its gold reserves for the 4th straight month, holding about 73.6 million ounces worth $209 billion as of February 2025, signaling it's diversifying away from U.S. dollars. Russia has also been stockpiling gold while slashing dollar assets amid sanctions. Saudi Arabia is quietly boosting its gold reserves too, aiming to hedge geopolitical risk. A Reuters OMFIF survey shows 70% of reserve managers now avoid the U.S. dollar due to political uncertainty. The World Gold Council says 76% of central banks plan to raise gold holdings and reduce dollar reserves in the next 5 years. This trend isn't just European, it's global. If major economies follow, the era of dollar dominance might be fading fast. Global financial systems are shifting, and the next gold move could come from beyond Europe. Trust has underpinned the global financial system for decades, but cracks are now appearing. A recent OMFIF survey found that 70% of reserve managers view the U.S. political environment as a deterrent to holding dollar assets, up dramatically from just 31% last year. Meanwhile, the ECB reported that gold now makes up 20% of global official reserves, compared to just 16% for the euro. Central banks are responding. The World Gold Council says 76% plan to increase gold holdings, and 73% intend to cut dollar reserves over the next 5 years. As one Reuters poll notes, the dollar has fallen nearly 10% this year, and 80% of FX analysts expect it to remain weak amid tariff, debt, and Fed uncertainties. With trust slipping, countries are shifting reserves into gold and alternate currencies, signaling a slow but steady unraveling of America's monetary hegemony. Since launching new tariffs in early 2025, President Trump's plan appears to be unraveling. The U.S. dollar is plunged by over 10% in the first half of 2025, the worst start since 1973, despite rising Treasury yields. Analysts from Deutsche Bank warn this reflects volatile domestic policy undermining confidence, while a Financial Times podcast calls this drop significant, driven by fears over trade and debt. Wealth managers from St. James's Place and Rathbones are shifting out of U.S. stocks, citing tariff uncertainty. Even David Roach, former Morgan Stanley banker, predicts a 15 to 20% further dollar slide and a recession by year-end. What began as trade leverage risks backfiring into a crisis of trust, weakening the dollar, unsettling global investors, and threatening America's financial power. Gold is no longer just a safe asset, it's becoming a global message. When allies like Germany and Italy fly nearly 4,000 tons of gold out of U.S. vaults, they're not just moving metal, they're moving trust. A system built on belief in the dollar is now shaking as nations vote with their reserves. As the World Gold Council reports, central bank gold buying has hit over 1,000 tons per year for 3 straight years, a level not seen since Bretton Woods collapsed. The message is clear: countries are preparing for a world where U.S. financial leadership is no longer guaranteed. Freddie Mac now reports mortgage rates averaging 6.77%, and analysts say trust, not just interest rates, is the real anchor of a currency. Each gold-laden flight across the Atlantic chips away at the foundation of that trust. What happens if more countries follow? The next flight could change the rules of global finance, and the dollar may not be in the pilot's seat. The gold is moving, and so is global power. As trust in the dollar fades, the financial world edges toward something far more unpredictable. Subscribe for more breaking stories, like, share, and drop your thoughts in the comments below.